Welcome back. Today we're diving into NXP Semiconductors. Their Q3 numbers just landed, but it's the guidance that really got people talking.
That's right. We're looking at what drove that positive buzz,
Right.
the financials, the strategy, and whether NXP is really signaling the start of an upswing.
So let's start with that market reaction. NXPI shares, they popped pretty quickly, right? Up about 2.7% after hours on the 27th.
Yeah, they did. But interestingly, the Q3 results themselves, well, they weren't exactly blockbuster beats, more like solid ground.
Okay, so what were the headline numbers then?
Well, on the non-GAAP side, and that just strips out some of the one-off stuff, adjusted EPS was $3.11.
It was pretty much dead on the estimate, like $3.12.
Exactly, matched expectations. But, and this is important, that's still down 10% compared to last year.
Right, so profitability down year over year. That doesn't scream buy the stock.
Precisely. And revenue was similar, $3.17 billion, just a hair above the $3.160 billion expected.
But also down, what, 2% year over year?
Down 2%. So Q3 itself wasn't about massive growth. It was about hitting the mark. Stabilizing, maybe? The excitement wasn't about those results.
It was about the direction. I saw the CEO, Rafael Sotomayor. He said revenue beat their own midpoint.
He did, but he quickly pivoted, didn't he?
Yeah, he highlighted, quote, broad-based sequential improvement across all regions, all markets. That sequential bit feels key.
It absolutely is.
Yeah.
That's the hint. Q3 sort of stopped the slide, maybe.
Yeah.
But the Q4 guidance, that was the real story. That's what lit the fire under the stock.
Okay, let's unpack that Q4 outlook then. This is where NXP seems to be saying, okay, the worst is over.
Definitely. They guided Q4 revenue between $3.2 billion and $3.4 billion.
And that midpoint, $3.3 billion, that was above what Wall Street was looking for.
Comfortably above, yeah. And look at the growth implied there. Sequentially up about 4% at the midpoint, but year over year,
A positive number finally.
a positive 6% year-over-year growth projected at that midpoint. That's the shift from decline to actual projected growth.
Yeah.
Big signal,
And it wasn't just revenue, right? The profit outlook, the margins, that seemed even stronger.
critical point, yes. Non-GAAP operating income projected between $1.08 billion and $1.21 billion for Q4.
And the street was expecting.
Around $1.11 billion. So that midpoint guidance from NXP is significantly higher. That speaks volumes about their confidence and efficiency.
You mentioned efficiency or operating leverage. Can you just break that down quickly? Why is that margin beat maybe even more telling?
Sure. Think of it like this. NXP has factories, R&D, big fixed costs. As they start selling more chips again, those costs don't jump up proportionally.
Right.
So each extra dollar of revenue, once you cover those fixed costs, generates a lot more profit. Guiding margins that high means they expect volume and efficiency. They're saying, we're going to make more money on each chip we sell going forward.
Which really backs up their commentary about early signs of a new upcycle. Better visibility, short cycle orders improving.
Exactly. And remember the context here. Peers like Texas Instruments, they kind of disappointed recently. There was skepticism about automotive and industrial recovery.
But NXP is doubling down on those areas.
They are. By signaling this upcycle, especially with short cycle orders picking up that's immediate demand,
Yeah.
NXP is basically saying our specific markets, auto and industrial, they might be turning the corner faster than others.
Okay, so where did we actually see those sequential improvements starting in Q3? Let's look at the segments. Automotive is the big one, right? Like 60% of revenue.
Yeah, you start there. Q3 auto revenue, $1.84 billion. Now, here's the interesting bit. Year over year, it was flat. 0% growth.
Flat, which, as you said, doesn't sound exciting, but in this environment.
Flat is the new up. It suggests the bottom. Management explicitly said the inventory burn is coming to an end for their big Western Tier 1 customers.
Ah, so those big auto suppliers were using up old chips. Now they might have to start ordering new ones again.
That's the theory. For months, they drew down stockpiles. If that's ending, new orders have to match actual car production demand. Flat revenue suggests they've cleared out most of that excess inventory. Q4 should see real demand flowing through.
Makes sense. That inventory reset is huge. What about industrial and IoT?
That showed clearer signs of life already in Q3. $0.58 billion in revenue. That was actually up 3% year over year.
Okay, positive growth there.
Yeah, and they called it broad-based recovery, factories, automation, even consumer IoT picking up a bit. Suggests maybe that correction is easing too.
And mobile, I saw that was surprisingly strong.
It was $0.43 billion, up a solid 6% year over year. So that held up well.
Which just leaves communication infrastructure and other as the weak spot.
That's the laggard, yeah. Down 27% year over year at $0.33 billion.
Yeah.
But given the size and importance of auto and industrial starting to look better,
That weakness gets overshadowed a bit.
pretty much. Investors are focused on the big engines turning back on.
And how did they manage costs through this? Gross margins.
Held up really well. Non-GAAP gross margin hit 57.0% in Q3. That's right in their long-term target range, heading towards the higher end, actually. Shows good cost control.
Okay. What about the cash conversion cycle? That went up a bit, 134 days.
It did tick up slightly. That just means it's taking a little longer to turn inventory into cash, about 4.5 months.
So inventory still needs watching.
Yeah, it suggests they're building inventory a bit, likely anticipating that stronger Q4 demand they guided for. It's a sign of confidence, but also something to monitor.
Right. Now, looking longer term, NXP has some pretty ambitious goals. High single-digit growth through 2027, doubling EPS by 2030. What are the strategic pieces falling into place?
It's a lot about focusing the portfolio. They're leaning hard into what they call the intelligent edge, especially cars becoming, computers on wheels.
Software-defined vehicles. And they're buying tech to get there faster. M&A.
Yeah, exactly. Targeted deals. They bought Kinara AI, that's for AI processing right on the chip, Edge AI, for industrial and auto applications down the road, maybe 2028 timeframe.
Smart move.
Yeah.
What else?
Close the deal for Aviva links. That's about super fast in-car connectivity, automotive SerDes, needed for all the sensors and data in modern cars.
And they're selling stuff too, tidying up.
Yep, classic portfolio management. They're selling their MEMS sensor business line, microelectromechanical systems. Could bring it up to $950 million cash.
So selling maybe slower growth assets.
To fund investment in the high-growth areas like AI and connectivity. Makes perfect sense.
And they're still innovating in their core EV market too.
Oh, yeah. New 18-channel battery cell controller. That's for managing the big high-voltage batteries in EVs. Crucial tech as EVs get more complex, keeps them central to that whole electrification trend.
Good stuff. And quickly, capital return. Still committed to sending cash back.
Firmly. Policy is returning all excess non-GAAP free cash flow. In Q3, that was $310 million back to shareholders.
How did that break down? Dividends, buybacks?
Mostly dividends, $256 million.
Yeah.
And $54 million in share buybacks. So they're investing and returning cash. Balancing act.
So wrapping this up for you listening, the Q3 results. They showed NXP found its footing, stabilization confirmed.
Right. But the Q4 guidance, especially the strong margin forecast, that's the real takeaway. Management sounds confident the cycle is turning up, led by auto and industrial finally recovering.
Which leads to that final thought.
Yeah, the big question now is about that inventory reset. NXP is betting the auto inventory burn is basically done. So you need to watch the Q4 results like a hawk. Do shipments really snap back to match end demand?
If they do.
If they do, and NXP is right about this timing, are they stealing a march on their competitors? Are they leading the recovery, or will everyone else in the industrial chip space suddenly bounce back at the same time early next year? That competitive positioning is what you watch next.